the US market, and I'm talking about US large caps, are currently trading at the 97th percentile of all CAPE data going back to 1880. And I think that's the issue with the animal spirits part of it, which is, um, when the bulls run, it's great, but when they start, running towards you and for the exit, it gets pretty bloody pretty fast.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Animal spirits have certainly been running wild in the stock market of late. The S&P is up over 1,000 points, roughly 25% in the past 4.5 months. Is this a new era of easy gains, as giddy bulls are proclaiming? One that investors should just jump on in and make the most of? Or is this the latest incarnation of irrational exuberance, and is caution warranted instead? For insight, we're fortunate to speak today with Jonathan Treussard, former partner and head of product at Research Associates and now founder of Treussard Capital Management. Jonathan, thanks so much for joining us today.
Thanks for having me.
Such a pleasure. This is the first time you've been on Thoughtful Money. In fact, this is the first time I've had the opportunity to interview you, Jonathan. I'm really looking forward to it. One of the topics I want to dive into you on this discussion is what is driving the animal spirits in the markets right now, especially as that gets manifested by some of these story stocks like NVIDIA, which I know you've been following very closely recently. Yeah. So we'll get to that soon. But if we can, let's just start at the point I like to begin all these discussions with. What's your current assessment of the global economy and financial markets?
Well, that's a great question. I think it's pretty clear that the global economy is really walking a fine line between a lot of data pointing to, a very resilient, particularly a very resilient U.S. economy, which, as we know, is critical to the global economy, and of course, a huge amount of risk and uncertainty on a variety of vectors, everything from geopolitics to the credit standing of a lot of major players, whether they be sovereign or particular sectors like commercial real estate. I think it's interesting to think about what we've been experiencing over the last 4 years, particularly since COVID started, as having played. I guess the way I would say it is, if you're tired, that's okay. It's been a minute. And as a result of that, I think a lot of people are trying to process information in real time while, running on fumes intellectually. And so it's causing just a lot of confusion. The other part of it, and this is something that I was talking to someone I respect very much in New York recently, is to recognize that the print is not sufficient to understand the way people are experiencing reality. One of the things that I was talking to this person about was the fact that if you look at the U.S. Consumer, the U.S. households, you say kind of everything is great. Unemployment is down, real wages are finally growing, so on and so forth. And you say, well, why are you walking around like the world is on fire? Why are you walking around with your head down? And I think the reality of it is risk. Risk has been realized for a lot of people over the last 4 years, and as a result of that, they're thinking about it on a prospective basis. A good way to think about not past inflation, but for example, prospective inflation is the fact that I don't really care what my wages are today. I'm looking at my paycheck and I'm worried that I don't know what it's going to buy me in a year. And so in a real way, no pun intended, inflation uncertainty is like a wage cut right now, even though it hasn't happened. So look, the reality of it is the U.S. economy is strong. And that has caused, I think, some of the runway we've seen in markets. It's stronger than we all anticipated, certainly about, 15 months ago when we went into 2023 with, near 100% probabilities of recession. And so in a lot of ways, we've dodged a lot of bullets. And by the way, some bullets we hadn't seen come along before they hit us. Things like the bankruptcies of regional banks and Silicon Valley Bank and so on and so forth. So that explains some of it. The other part of it is, and this is where it's hard to, and I think we've gotten some data on that particular front last week with the Fed. The reality of it is, I think operation whatever tightening at large, whether it's quantitative or real, was put on hold back in March of 2023 when those banks went under. And so it's just we've been kind of floating out there with the impression that we're tightening, but not really, really. And so I think that's been causing a lot of uncertainty in the market. We just the officials are telling us one thing, but the reality of it is, I think QE in particular was squarely put on hold back in March 2023.
All right. So sorry, you said QE was put on hold back in March
I'm
of
sorry,
2023.
QT I meant.
Yeah, that's what I figured you meant. Yeah, and we've had a lot of folks on this channel of late, Jonathan, really kind of digging into the whys of how what supported the economy, what has supported markets despite the rate hikes and QT, and it seems pretty clear that on a net basis, liquidity has been rising all through then, that it really bottomed in October of 2022, which is right when the markets bottomed. And as liquidity has continued to increase, so has economic growth, and so has financial asset prices. I think the big question hovering out there in the world right now is, well, how long can that continue for? And there's a lot of debate on that because liquidity is not a really easy thing to measure, and everybody kind of has their own version of how they measure it. But alongside that has been there's one thing about the tide rising, right, that raises prices. There's another thing about expectations for the tide that can cause prices to rise even further, right? That's multiple expansion, right? Yeah. So let's get right to the heart of the discussion I wanted to have with you, which is how healthy and sustainable do you see the current stock market rally? I mentioned the fact that the S&P is up like 25% since the October lows, right? In 2023 itself, the Magnificent Seven, we're going to talk a lot about those stocks, I think, they were up 106% that year. The NASDAQ was up 54%. The S&P was up
totally
24%.
Normal, right?
Yeah, exactly. The S&P was up 24%. And again, to your point, nobody would have seen that coming at the beginning of 2023, right? We were all still in the throes of, oh my gosh, the stocks and bonds, cratered in 2022, and this inevitable recession's right around the corner, right? So everybody was surprised. So let me just ask you first, have these valuations, the current valuation state that we're at right now with financial assets, has this been well earned, or is the market pricing to some sort of fantasy at this point?
So what do we know? We know, on the one hand, again, earnings and the economy have been stronger than we anticipated. So it is very clear that part of it is just the bogey, the hurdle going into 2023 in particular was just very low, and we beat it. But, and again, you mentioned that I used to be partner and head of product at Research Affiliates. My former colleagues maintain a website with CAPE ratios for a whole range of markets. Schiller PE ratios, which measure valuations on a longer horizon. And I was reminded last week when I went and looked at the most recent data that the U.S. market, and I'm talking about U.S. large caps, are currently trading at the 97th percentile of all CAPE data going back to 1880. 97 isn't quite 100, and I think that's important to note. In fact, we were even more stretched before the decline of, the late 2022 period. But 97 is still about as high as it's been in over, nearly 150 years. So that's where you have to say, look, do I think we're in the, middle of a huge bubble? There are arguments for discounting that, but the reality of it is the valuations really don't give you a lot of comfort should anything go badly. And again, I think that's the way to think about it, which is we've been just, as you're walking along the street and you're skipping over a bunch of cracks, and we've been skipping over, more than our fair share of cracks recently. Um, but if we step on one, it could get ugly real fast. And I think that's the issue with the animal spirits part of it, which is, um, when the bulls run, it's great, but when they start, running towards you and for the exit, it gets pretty bloody pretty fast.
Okay, so let me I want to get to the actual question of are we in a bubble right now? Because you've actually uh, done a bunch of academic research in this space. Before we get there, though, let me just sort of stay with the markets as they are right now.
Yeah.
So we have these stocks, the Magnificent Seven, that's been driving a lot. They've been the quarter horses, pulling the rest of the market behind them. There's some debate now: are we down to the Magnificent Six or five or even
Or maybe
four?
two or three.
Yeah. But it seems clear that the lead horse or the lead sled dog, whatever analogy you want to use, is NVIDIA right
Yeah.
now, right? And NVIDIA has just been on an incredible tear. Shares have basically doubled since the start of this year,
Yeah.
right? Um, so, and they had a phenomenal run, in 2023. So that's on top of another amazing year. So, NVIDIA is the poster child for the AI boom, right? Um, and I guess one question is just, um, there's no doubt, unlike the dot-com boom where some of the highest flyers had zero earnings, right? There's no doubt there's real earnings. This company is making tens of billions of dollars. It is growing its revenue at a staggering rate. Um, but that aside, if we just look at the valuation metrics, are they in line with the performance of the company so far? Or are we getting into kind of crazy mania style valuations? And in your answer, if you can maybe talk to price to sales for NVIDIA as one
Yeah.
example.
Yeah. No, so I think it's so again, as you noted, NVIDIA is a really interesting example because the reality of it is this company is in the right place at the right time. And by the way, kind of got there in a semi-random way. I mean, they started with cards that were great for video games, and then all of a sudden were great for, mining Bitcoin. And all of a sudden there's, arguably the most high value application yet with AI. So that's number one. This company has got a thing and it's real, and it's been very fortunate to be the right party at the right place, right time. And I think it's to your point about price to sales, price to revenue. There's some, the number is some version of 30, which and probably actually higher now, which means that what you would have to do for, as an investor to get your money back out of this thing would be to stop all activity, all capex and so on and so forth for the next 30 years. And then, eventually you'd get your capital back, which is, a pretty tall order. What I think is interesting, and again, I feel like NVIDIA has been, as the expression goes, renting space rent free in my head, and as I think a lot of other people as well. Um, I think it's irrational to think that NVIDIA will forever be the monopolist in this market. That's number one. And clearly, part of the excitement is it's the only game in town today. But is it really going to be the only game in town in the next 10 years? That seems fairly unlikely, particularly when you go back to this concept that it's going to take 30 years to get your money back. So that's number one. Um, the other part of it is you're right, the earnings, the revenue line has been incredibly strong, and these chips have been selling at very high prices. A good analogy would be, you're looking at cars on a a lot at a car sales place, and all of a sudden the MSRP doesn't mean anything. Everything's going for 2-3x the price.
Right.
Um,
Which
and
we saw 2 years ago during
Yes,
COVID.
no, totally. These things really do happen. But you have to ask yourself, why are they happening, and is that sustainable? And again, at the risk of playing fundamental analyst, which I'm not, the sustainability of earnings is really important here. These things are going at a huge premium relative to where they were, like an hour ago. And it's hard to believe this is part of the um, suspicion, not fact, but I think it's a reasonable suspicion. I think some of it is a premium related to the idea that these chips shouldn't be finding their way into China, but there's no way they're not. The data of import and export going into China suggests otherwise. And so my suspicion is some of the premium is just the cost of getting these things to places they shouldn't be going to. I'm just going to guess that. But even if you don't know that that's happening, and we don't, I don't, um, again, I think beyond the irrational exuberance possibility, which is here, I think. A lot of what we're seeing with Nvidia is what I would this, again, I look at markets often because, as you said, I've been a student of bubbles, quite literally since, I was a baby in this profession back at UCLA, studying some of the biggest bubbles in history with Earl Thompson. I tend to look at markets as a behavioralist. And yet, I'm coming to conclude that one way to make sense of NVIDIA is to look at it as an efficient market kind of risk premium. And let me give you a couple of ways to think about that. One is the one that I just suggested, which is NVIDIA really needs to have a global market for this thing to make sense from a valuation standpoint. And whether or not these chips are finding their way into China today, which again, I repeat, I don't know, though I suspect it's happening. NVIDIA is living in fear, and the investors in NVIDIA have got to be living in fear of a world in which, the globe really breaks into two, and the addressable market isn't the world, it becomes the Western world. And I think every day that we don't get to that point is a day where, investors in NVIDIA stock have got to be rewarded for the risk borne but not realized. That's number one. Um, I think there's some political risk too. Right now, AI is in the infancy phase where, there isn't a lot of regulation, certainly not in the US, that's been put in place. And so this is kind of like best case scenario pricing where, most anything is on the menu. It's hard to imagine that we're going to be living in a no AI regulation world forever. And so I think there's some political risk again, that we don't know what that's going to look like. And then the last one is very, very like plain vanilla, old school thinking about markets. As excited as we are about AI chips, I believe that NVIDIA has a huge amount of what I would call real economy beta. And what I mean by that is not their correlation to the stock market, but their correlation to the real economy. And if and when, because we know these things will happen, when the economy really slows down and takes a hit, and corporates are wondering how to make payroll or certainly where to cut, my suspicion is, U.S. corporates will worry about those things before they worry about investing in AI applications. And the way I would say it is the U.S. consumer is going to worry a lot more about where their next meal is coming from and where shelter is coming from than, use of AI. And so this is a really exciting thing that's happening, but under the best of circumstances. And when those circumstances change, the really exciting thing might be, put on the back burner for a bit.
Well, Jonathan, you're taking this conversation where I want to take it. I'm going to ask you in a bit about your macro outlook in terms of what you think is going to happen in the future with the economy, because you started with the economy, U.S. economy resilient, certainly resilient relative to most of the other major world economies. I've had a lot of people on this program, you don't have to agree with them, but that are saying, if you look at the headline numbers, yep, things still look pretty good in terms of unemployment and GDP growth and stuff like that. But if you start to dig, and in some cases not very deeply, you can certainly come up with a lot of skepticism about where things are headed in the future. You're nodding as I'm saying this. You even said a few minutes ago, when you have a market that's basically priced for perfection and you're stepping over cracks, if you eventually trip on one of those cracks, that could bring things down. So even you are seeing cracks somewhere in the system, right? So I'd love to talk to you about, well, big enchilada, what do you think the risk of recession is in the near to midterm? We'll get there, but let's stick with NVIDIA just for a few minutes. So you just raised a bunch of risks that really don't seem to be priced into the stock right now, right? It seems like no matter what happens, the answer is it's a good day for NVIDIA, right?
Yeah.
So let me just pull up a quick chart here if I can. This is a chart of Tesla, right, which is one of the Magnificent Seven. It's the fallen angel right now in that group. And you'll see here, Tesla hit a high of over 400 bucks a share right at the end of 2021. It's now trading at about 178. So it's been more than cut in half over the past 2+ years, right?
Yeah.
And back when it was 400 bucks a share, all we heard was, oh my gosh, you folks that aren't Tesla bulls just don't get it, right? It's not just a car company, it's a software company, it's an energy company, it's a bet on all these different things, right? It's going to totally transform the world. And that's why Tesla was worth more than the market cap of, Toyota and GM combined and all that stuff, right?
Yeah.
That was the narrative that was pushing it at that time, right? And there were a lot of people at that time saying, man, this stock is priced for better for perfection. And of course, the bullish argument was, yeah, but you guys just don't understand the scale and the scope of the market opportunity that they're going after. I feel like it's very similar today with NVIDIA, and I'm not an expert on NVIDIA, right? But it seems like first you have to buy into AI, and that we're going to start realizing value gains from implementing AI really fast. And that NVIDIA is going to be the main dog for a long time in the space, and that competitors aren't going to eat its lunch. And to your point, that some of these other risks, like regulators aren't going to come in and say, hey, look, you can't sell to the half of the world that we don't like right now, and all this stuff, right? So it very much feels like that movie is playing out again here. I'm not saying it guaranteed is, but I'm just saying it feels very much like Tesla did back then. What are your thoughts on that?
No, I agree. And again, I think the Tesla story was probably a little bit sillier, just period. But NVIDIA's got a lot of that going on nonetheless. And by the way, if you pull up the NVIDIA chart, you'll note that, NVIDIA had a major correction the last time around when people went from, crypto and NFTs for all to crypto winter very quickly in 2022. I don't remember exactly the numbers, but some version of down 30% or down 40% seems.
Yeah, I'm pulling it up. It's hard to see,
Right.
just
So,
because the
but if
stock
you
has
if you
done
just
so
go to
well.
if you just go to that peak around the number 2022, what is that?
Yeah, that's 330.
Call it 330,
Went down to 112.
right? So
Right.
that's
Yeah.
that's down 50, some version of 50%. The point is that's just the stock. And again, now to your point about the scale, it just looks flat, but it was down 50%. By the way,
Sorry to interrupt, but if you can, in your answer, just address this. What is the rationale for it being worth 148, let's say 150 at the start of 2023, and it's now almost 1,000, right?
look, I mean, yeah.
940.
I think the revenues really have gone hyperbolic. There's no question. The point is, are the revenues, sustainable and real, and not real in a accounting fraud sense of the term, as in, reliable as a go forward indicator. Um, I, and that's the challenge. I just, again, just think about the world in which we live, which is predicated on competition. In what world is there nobody in the wings looking at these revenues that have just gone through the roof and saying, I'd like to get some of that myself. And I'm going to be throwing some money at it. So just the sheer nature of competition in the marketplace, it just doesn't seem likely that whatever's just happened to the revenues of Nvidia is going to happen again in a sustainable way. And I think that's the way to think about it. If that makes sense. And yes, I just think again, I think the Tesla thing was always, extra silly. So it's hard for me to say it's just like Tesla. But there is some of that going on, no question. And if you're talking about AI, then you've got to be talking about NVIDIA. And I just don't know that that's an equivalence that is going to hold for very long. Yeah, again, I think about, and you were mentioning the tech bubble earlier. I was thinking about how much value was created by the original tech revolution, and I'm talking about what happened between, call it, 1995 and 2000. And I can only imagine that only a small fraction of the value generated actually went to the key players at the time. I don't care how rich people got at Microsoft. I guarantee you that it was only a small fraction of the amount of societal wealth that was created then. And I just don't. Right now, what we're seeing is NVIDIA shareholders capturing more than 100% of all gains from AI so far. First approximation.
Wow. Okay, that's a big and important statement. Whereas we've seen in previous cycles, everybody gets their bite of the value creation, but the value creation is the big pot. You're saying we estimate the value creation of this new AI boom, and it's going all to one player, and in fact, maybe even more than 100% right now is going to that
Look,
player.
I'm not saying these are actual figures. I'm saying I think it's an intellectually reasonable way to think about it.
Yeah. All right. Well, look, just to make one more sort of Tesla NVIDIA comparison to get your reaction to. So, Tesla, again, at its height, it was, all right, EVs is the way the world is going. It's a much better car. The new Green Deal is going to electrify the transportation grid. It's got
Yeah.
nothing. This whole sector's got nothing but tailwinds behind
Yeah.
it, right? And here we are, fast forward 2 years later. The bloom is kind of coming off the rose of the EV market. I'm not here to denigrate it, but there's definitely been a lot of questions that have been asked about, do these cars perform as well as we thought? Are they as efficient as we thought? Are they as green as we thought? And there's a lot of arguments to suggest that they're not. So, and the laggard in this space was Toyota, who hadn't really done much in the 100% EV category and stuck with their knitting of hybrids. And it seems like the pendulum is now starting to swing back to the hybrid space, and hybrid might be the model that emerges here as the winning horse in this race. Too early to tell, and I'm not an expert on this, right? But I'm just saying that the narrative isn't just EVs are the solution for everything, the way that it was a couple of years ago. So one might say that that's an open question. Where in 2 years from now, might we be saying, oh yeah, there's a lot of things to expect from AI, and it's real, and it's going to make big difference in the world over time, but it's not this cure for everything that it's kind of currently being sold as.
I think that's right. I think that's completely right. Clearly, the thing is going to change, our reality. I think it's hard to imagine a world in which, in which people say, nah, it really was just, all kind of hot air. But right now, again, everybody, it's a little bit, you have to look at where the silliness is happening. And right now, everybody's got an AI company, and it's a little bit. I think a friend of mine was telling me recently, someone was pitching him an AI solution for his company, and he said, "Well, great. What does it do?" And the pitch was, "Well, it can do anything you want it to do." And you're like, "How about you build a product that actually helps me in my job, and then you come back?" So I think this idea that it can do anything, has the distinct advantage of being fuzzy. Um, but the people that are actually going to be allocating dollars, they're literally taking out of their bottom line to improve their business, are going to be a little bit more discerning than, cool, this thing could do anything.
So one of the and again, I'm not an AI skeptic, but I do think that the hype has maybe reached uh, levels of fantastical expectations in certain areas here. And one company that kind of makes me feel that way is Reddit, and looking at the Reddit IPO right now. I'm
Yeah,
curious
yeah,
if you have any thoughts on that. So I know a little bit more about Reddit than the average person because I worked at Yahoo for 10 years. So I
yeah,
sort of know that space fairly well. And as I understand it, the reason why Reddit became red hot and wanted to IPO to capitalize on it was I can't remember which AI player, but maybe it was Google, I think, approached them and said, "Hey, we want to basically license your archive, right? And
right,
we want to train our AI on your gazillions of posts from regular people, right? It's
right,
a ton of content that we're going to learn from, right? And okay, just taking that at face value, I get it, but that's a one-time gain to
right.
Reddit. When you talk about how real are this revenue growth, right? That's a one-time hit. And I mentioned that on Twitter, and somebody said, well, hey, they can license it to the other AI players. I'm like, okay, great. They get a few more checks, right? But then it's done. It's a one and done thing for them, right? So the people that are getting all excited about Reddit right now, they're putting a big multiple on that company. And I think the multiple part is really questionable. Now, secondarily, there's the concern I have, again, maybe knowing Reddit a little bit better than the average person, of kind of garbage in, garbage out, right? I wonder, like, what is your AI going to learn
Well,
from these
that's
Reddit
I was
posts?
gonna say. Like, I prefer not to consume some of this stuff, and whether that's in a direct fashion or indirect fashion through some kind of machine learning, on it. Um, but I think that's right. And again, part of it. Look, data companies clearly have been going at a premium for a long time. I mean, by the way, again, you going back to uh, old fogey things that most people wouldn't even think of as data companies, the old MSCIs of the world, or
Mhm.
even some of the index companies. So there's value in data, we know that. But to your point, when the data you have is just and I don't want to be overly denigrating, but potentially an open sewer of human psyche in some corners. I'm not sure I want to be learning from that. But most importantly, the thing that is worth remembering is the only way in which data truly are valuable is, to your point, if they're gated. And if everybody cuts the check and everybody learns on it, then the marginal value of that training ground is very quickly back down to kind of, the foothills, because um, it's now part of the bloodstream. So I think, to your point, if Reddit has value, and I think it clearly, AI is starved. The large companies are starved for data they can consume without getting sued, and one of the surest ways of doing that is to buy the data. But that again doesn't seem particularly replicable over time, which presumably is what a shareholder would want, as opposed to someone who just wants a one-time payout. That payout is done. Now it's just a question of who's going to be holding the chips when it happens. Um, but yeah, I think you're seeing a lot of this stuff. And again, I'm trying to give people credit. I'm trying to understand where it's coming from. I think there is an existential. I think a lot of this is excitement, and it's easy for me to make fun of excitement when I think it's excessive. But I think a lot of it is existential fear. I think people are in a mind frame where they realize the world is changing, um, and if they're not on the right whatever you call it, inflatable boat off of the Titanic, they might be left, in a pretty bad place. And so they're trying to figure out, how do you accrue, kind of units of value before the thing really radically changes and the order has been, flipped upside down.
That's so interesting that you put it that way, just because I would have said, yeah, fear is driving this, but I would have said it was not an existential fear, but FOMO, right? Of just, hey, the market opportunity is concentrating, right? We've got one of the most narrow breadth markets that we've ever had, right?
Yeah.
And the folks that are in the winning boats are making a killing, right? And everybody else is looking around and saying, all right, I want some of that,
Yeah.
right? Like, and so to me, it feels more like, hey, I want a winning lottery ticket, and there's some of these companies out there that seem to be them. Screw what I've been told about a well-diversified portfolio or not stretching for risk or whatever. I'm going to grab that thing, right? Especially because my idiot neighbor, idiot brother-in-law, keeps bragging about how much he's made on his Nvidia or his Bitcoin or whatever whatever speculative asset is shooting the moon right now. And I would have said that was driving them, less than hey, the world has changed, and I got to be part of the new fancy thing. But I don't know, maybe that's a flavor of it. I don't know.
Yeah. I mean, and by the way, again, I think I guess the reason I'm willing to go there is twofold. One is I think it's too easy to make fun of your, dumb brother-in-law making money and whatever. So the straight FOMO, the meme stock FOMO is just
Mm-hmm.
silly and pedestrian, and if that's the scenario, it will resolve itself because silliness doesn't get rewarded in the long run. But I do think, and again, this is where I'm willing to um have more compassion perhaps, or just a better feel for it, is forget FOMO. Maybe you and I are coming up with a new acronym, EFOMO, which is, existential FOMO. And I think in a world in which you're looking at, again, think about everything we've lived through in the last, call it whatever, whenever you start the clock, but let's just call it COVID. Okay. And you're saying this world is changing radically and in ways that I don't love and don't care for. And, I've been put through the ringer. And now there seems to be this new thing that may be taking, the economy and the world in which I operate in a completely different direction. And I think it's reasonable to say, again, I'm trying to be educated by what I learned from looking at the big bubbles in history.
Yep.
Sometimes the social order changes. And when it does, people want to make sure they're on the right side of the ledger. It's not confusing. And so I think that's part of it. Some of
Yeah.
it is just straight up FOMO, is like how many dollars in my account, and I think if some of it is like where am I going to be on the societal totem pole when this thing is over?
Got it. And also maybe too on the corporate totem pole, right? Which is like, hey,
Sure.
just like in the dot-com era, everybody was scrambling to figure out how to get some digital part of their business. There's probably a lot of that with AI right now, which is, hey, it seems like that's where it's going. We better invest big in AI now, even if we don't fully understand it, because we just don't want to be the dinosaurs in the story.
Yeah. No, I think
If
that's right.
AI is the asteroid, we don't want to be the dinosaurs. Yeah.
I think that's right. I think that's right. And so I guess my point to you is the reason I choose to think about it in those terms, at least at the margin, is that it allows me to have, as I said, have a little more understanding, and maybe, it's, I don't want to just be dismissive of a bunch of people doing silly things, because
Yeah.
I think that paints too much of a caricature, and either scenario isn't great. I'm reminded of a piece that David Natick, um, wrote recently, and it's like the bubble scenario isn't great, but like the world order changing scenario is also pretty intense. So I think it's just
Right.
you know uh
And if they both result in a bubble, whatever the driving force, it almost doesn't matter, does it?
yeah, no, I think it's just, I mean, again, that the and this goes back to the way I think about bubbles. And please don't misconstrue what I'm saying as being conspiratorial in nature. It's just a mechanical thing. Bubbles are a wealth redistribution mechanism. There are people that lose money and people that make money, and that's the bottom line. It's just the reality of it. And so I think part of it is like, who's gonna, by the end of this thing, who's gonna end up with more chips and who's gonna end up with fewer chips?
Okay. You're giving me so many great directions to go in. We only have about 20 minutes left, so I'm going to try to get through as many of them as we can. So first off, to round out this bubble discussion, and by the way, I just want to remind folks of your credentials here. You wrote academic research back at UCLA on financial bubbles. You did this in the aftermath of the tech bubble. So you've got a good understanding of why and how bubbles form. You also, ran product, as I mentioned, at Research Associates, which I think, it influences how 150 billion in assets are
That's right.
managed, right? So massive scale. So you're not just some guy with an opinion. You're a guy who really understands the world in which he operates. So you know, we've kind of used NVIDIA as sort of a case study here, but as you look at the market right now, where are we on your bubble meter? Are we in one?
Um, I'm trying to be very thoughtful. I apologize for
Mhm.
the pregnant pause.
No, it's thoughtful money. Be as thoughtful as you
Yeah,
want.
yeah, yeah. I don't want, I don't want to be knee jerk about it. I think it's really hard. I guess on a meter, 1 through 5 or something, I think it's a solid 4. I think it's hard. I think it's hard to say everything points to bubble. I think that some things don't. Uh, but the predominance of the evidence suggests that this market isn't priced in a way that leads to really great outcomes for the next 10 years. How about that for a description?
Yep.
It's just, we know empirically, and again, as you noted, I'm a PhD economist, and I've thought long and hard about both the theory of finance as well as what the data inform us. This does not require theory. This is an empirical result, which is when valuations are high, prospective returns are lower, period. And whether that translates into I guess the reason I'm giving you a 4 out of 5 instead of a 5 out of 5 is I was recently looking back at the Japanese stock market bubble of the 1980s, and that was like super extra silly. That was like six
That,
out of five.
that was the granddaddy of all. Yeah, exactly.
Right. And so in a world where like the Japanese bubble happened, I can't call this quite a 5 out of 5 because I know there is room to stretch from here. But this isn't. This is, um, it's going to take a lot of great fortune for these valuations to turn into, healthy returns on a go forward basis.
Okay. Is it fair to say that you think we are in a late stage bubble at this time?
Late stage market.
Yeah, late stage market bubble, meaning we're getting close to the point where the gains we've seen are not going to be able to continue, and really one of two things are going to happen: either a pretty substantial correction to get prices down into better value, or a prolonged stagnation.
Yeah, I mean, again, this is where, the future is unknowable, and again, I really don't want to um at the intersection of humility and just the recognition that crazy things can get way crazier.
Yep.
Um, am I here to, beat the drum that that's it, we've seen the top? I have no way of knowing that. Um, but I'm not excited about putting more money in U.S. stocks at these prices.
Okay.
That's
And
the,
that's the that's where I'm headed with all this, which is, given this market environment, is it one that somebody should say, "Oh no, we're only in the third inning, so I'm going to ride this thing for a while," right?
I think it's just incredible. Again, you have to look at things from the perspective of the structure you have. And the structure we have, which are things like historical data and market valuations and, all of that, um, aren't suggestive that this is the beginning. they're suggestive that, a lot has already happened and a lot is already in the price.
Okay. All right. So let's see here. Let's go kind of to rapid fire, and then there's one topic I want to flesh out with you before we wrap up. So I talked earlier about like your macro outlook about where you think things are headed from here. You talked about, NVIDIA having maybe perhaps more economy beta in it than folks are realizing at this point in time. What is your expectation of the economy beta here? Do you think that the U.S. economy is strong and will stay strong enough for, let's look at this sort of with the rest of the year, perspective on it. Or do you feel that these cracks that you mentioned are going to, we're going to trip over one of them eventually? I like to use the term lag effect. We've had this we've dramatically increased the cost of capital, and yes, that's been cushioned by a lot of net liquidity factors, including things that the Fed has been in charge of, like the reverse repo program and the BTFP, both of which, by the way, are kind of ending at this point, right?
Running out.
Running out, yeah. And so, there's a good argument to be made, definitely a big debate to be had over it, but a good argument to be made that the lag effect hasn't been repealed, it's just been delayed and it'll eventually arrive. So do you have an outlook one way or the other?
Yeah. I mean, again, and I want to be very honest about the fact that this is about learning in real time. I thought at the beginning of this year that, the predominant argument, which was soft landing, had a lot of credibility. And I think it's very clear that the cards that have been turned over since, are taking us away from some version of soft landing to, kind of this no landing world, which is a really bizarre world. So I thought it was healthy to have, give some credence to the soft landing. And by the way, cheer for it. I mean, if we could have had it, that would have been amazing. Who doesn't want, an economy that slows just right without causing a huge amount of pain on people? That's, we should want that. But the reality of it is inflation. No, I think it's important to realize that a high inflation regime is also a high inflation volatility regime. That's just the nature of it. So once inflation is high, then, the month to month prints are just going to bop around just a lot more. But I think it's hard to look at the recent inflation data and not think that we're kind of stuck here. We all know the things that are going to wash out eventually if we're lucky, the OER, the rental equivalent, so on and so forth. But I don't know about you. I drive past a gas station every day, and it's pretty clear that, oil is going up and gasoline going into, the tanks of your neighbor's cars is going up, all of that. So I just think we're gonna live or die in a lot of ways by either just something bad happening somewhere in the economy, and it could. Again, I would be shocked if this, we had heard all we're gonna hear on the commercial real estate side of things. I just think there's a lot of losses on a lot of books. And yes, the Fed has basically just backstopped the entire banking system for the last year. But at what point does, one of those things, spiral again? Number one. So I think something like, CRE risk could easily get us there. And the other part of it is, it seems to me like the Fed has said, all right, we're just gonna, roll out the mission accomplished banner on inflation and be done with it. Um, if somehow someone gets a little bit more of a spine over the next few months and says we're not quite there yet, then the market could be in for a real surprise, and therefore the economy could be in for a real surprise, because I think we've all made peace with this funding rate for a period of time. And by the way, it's not awful. I think it's a decent place to be to make like reasonable economic decisions at the margin, but people weren't prepared for it. And so a lot of people are in the red.
Yeah. So if we had more time, there's a lot of data that I've pulled up, especially around the signs of weakness in the American consumer. Um, don't have time to go into that given the topic I want to go into here. But we'll flag that because I really would love to bet. So, get your thoughts on that, because one of the questions I have is how real is the current economic growth rate that we have right now, and not real, real versus nominal, but
Sure.
how dependable do we think this is going to be going forward, right? Um, but we'll have to punt that off for a different day. When we were getting ready to prepare, get on camera here, you brought up a great topic that given your expertise, that I wanted to give the audience a chance to hear, which is, you were head of product for, this massive uh, research firm that influences so much in client capital. Um, I, I believe, and don't let me put words in your mouth, but I believe that you were expressing a concern that, given the froth today, that there's a real incentive, one might call it a perverse incentive, for Wall Street just to sell whatever it can into that, right? And personally, I might think something like the Reddit IPO might be a good example of that.
Yeah.
But you mentioned a number of different categories right now that have become very popular, where you're kind of scratching your head and saying, okay, that's great for Wall Street to sell those things, but is that great for the market?
Yeah.
Are the people buying these things, are they fully cognizant of the true price of them? So if I'm capturing the spirit of this correctly, can you just sort of elaborate on this?
Completely, absolutely. And again, when I was head of product at Research Affiliates, we went by our mission, which was to do things for the benefit of investors. And so we often had requests for new products and new strategies, and we would sit around and say, but do we believe this isn't the benefit of investors? And if we said no, we would just say, like, I don't really care that there is, money in the banana stand. So, but that's the way a lot of product groups around Wall Street, in particular in asset management, operate. If there is money to be made, I don't really think long and hard, so to speak, about what it means for, whether or not this is an advisable product. I think it's all, and, you have to understand the incentives in the industry. So, on that kind of vein, and, again, there are the things that you and I think are reasonable markers of such issues. Silly IPOs is a good one. Private credit being shoved into a bunch of high net worth investors' portfolios is probably another good one for another day. But the one that is pretty obvious to me right now is what I would describe as engineered yield. And look, there are a lot of people for whom, distributions are important, particularly as they're approaching retirement, or, they're in a phase of wealth where they've made their money. They just want to get distributions out of it. And I'll give you two. And this is where, again, understand I'm a PhD economist, and I wrote my dissertation basically on option theory. So a lot of this is option centric. And so it helps to know that to get to the bottom line. Buy right strategies, hugely popular in kind of wealth management at large, has been made more popular by the fact that a lot of it has been going into ETF format recently, and sucking up a lot of AUM. What's a buy right strategy? You buy the stocks and you sell call options on top of it to spike the distributions. And you say, okay, that's great. That's an interesting thing if what you want to do is put a big fat distribution yield in front of people. But then if you're really asking yourself, what's fundamentally going on here, think about stocks. And again, start from the premise that, imagine the following conversation. Hey, these things go up a lot or they go down a lot. How about you keep the downside and you sell me the upside?
Hmm.
Okay. Then you say, you have one of two reactions. No, thank you. Right. Reaction number one. Reaction number two, at what price? Okay. If you're going down the path of reaction number two, which is probably a little bit more sophisticated, but by the way, I don't think no thank you is a terrible default. Then you say, okay, at what price? Well, let me tell you this. Implied volatility on US stocks is really low right now. We can talk about percentiles, some version of into 30 percentile going back in history. But the point is, these options you're selling for cheap. on a thing that leaves you with a bunch of downside and not a lot of upside. Is that worth it to you? That's question number one. Um, the other one, which kind of gets you a little bit further up, I guess the food chain in the world where people get interested in managing your money, is in private banking and private wealth. I'm hearing a lot more about what I would describe as structured notes. And these structured notes, again, are some version of, hey, you'll get 9% for the next year, unless the market is down 15% or more, at which point you'll participate in the downside, which is a cute way of saying you'll lose money. And then you say, well, okay, so these things have been engineered. It's literally in the title, structured note. And you say, well, how do you structure them? Well, it's like a treasury, which is currently earning roughly 5%. And then how do you get the difference between 5 and 9? Well, you sell a put. That's how you get to participate in the downside. Um, are you excited about the idea of earning an extra 4% on top of a really healthy treasury yield for the benefit of selling market insurance? And again, at fairly low prices today because implied volatility is low. So this whole kind of short, I guess, put it under the umbrella of short vol products, seems to me like um, a lot of marketing departments getting really excited about putting big fat yields in front of people, and those yields being finally easy to engineer because of where treasury yields are, um, but leaving me rather concerned that the people who are actually investing in those things don't get it, and when it goes badly, aren't going to be very happy with it.
Got it. Okay. So it's a little bit of a version of the, if you don't know who the patsy is at the poker table, it's you, right? Where Wall Street is amazingly inventive in coming up with new things to sell, to meet market interest or market demand, right? And
Yeah.
what I hear you saying is they're getting very creative with these engineered yield products, but you fear that a lot of the people that are buying them like don't really fully understand how they're going to work in every different scenario. And if today's current kind of Goldilocks conditions end for this product, suddenly the product could look a lot less appealing, and these people could be experiencing returns that they were just not expecting.
Yeah, I think that's right.
Okay. All right. So just one more caveat, folks, about Wall Street. Sort of like, hey, we're here from the government. We're here to help. We're here from Wall Street. We're here to sell you a great new product. Make sure you do a lot of your due diligence before jumping into one of these hot new products that Wall Street's pushing. All right. Well, look, as we wrap up here, uh, I did say what kind of wanted to get to the end of your thoughts on where the market may be headed from here. You've told us, hey, you think it's pretty stretched, 4 out of 5 on the bubble meter. And you don't want to you're not excited to deploy fresh capital, at least into stocks at these valuations. For folks, this is a channel that's, none of what you're going to say here, by the way, Jonathan, is individual financial advice. Folks understand that this is just for educational purposes only. I'm going to talk in a minute about what folks can do if they want to get advice from a professional. But they're just trying to figure out, okay, gosh, given the current state of this market, then I've got my financial capital. What are some of the things I should be considering doing with it? Obviously, it sounds like you're saying, look, this is the time to be more defensive than offensive. Are there certain strategies or certain asset classes right now that you particularly think are well suited to this environment, or maybe on the other side, particularly ill suited to this environment?
Yeah. So, and again, not financial advice. This is just looking at data and educating myself and sharing that education, because I think it's helpful to think about how returns are generated. We just talked about engineered yield, and I think a lot about reward for risk borne. And I think one asset class where it seems to me like the reward is well priced right now, and it happens to be that I think the edges of the scenarios, if you will, are pretty well understood. Is fresh, government-backed mortgages. And I'm not the only one talking about it. I know some of my friends in Newport Beach who live in fixed income land. I think you'll know who I'm talking about.
Mhm.
I know they're talking about it a lot. And if you think about what and I'm not talking about anything that's not government backed. But if you think about what I just told you, which is stock market volatility, implied volatility is very low right now. So it's not a great time to be selling options all over town. Bond interest rate volatility is very high. And so that becomes worth thinking about. And it happens to be that, like a Fannie mortgage, a fresh one, one that was just issued recently at some version of 6%, right? Is effectively functionally identical to being along a US Treasury, roughly a 10-year Treasury, and selling a call on it, because what you know is going to happen is if rates come down, right, people will refinance their mortgage. That's the prepayment risk. And all we know now is that that's a real risk. Now, again, I don't know that we're going back to a 3% mortgage world. And by the way, I'm not sure we want to go back to that world because that means a lot of bad things have happened. But the reality of it is, fresh mortgages seem to have a pretty decent risk return profile right now. Again, not, just looking at asset classes. So that's one I'll leave you with.
Great. That's a fresh one. I hadn't heard that one before.
Great.
All right. Well, look, as we wrap up here, for folks that have really enjoyed this discussion, and if this was their first introduction to you, where can they go to follow you and learn more about you and your work?
Sure. Well, the easiest way is to go to my website, www.treussard.com. That's T as in Thomas, REUSSARD as in David.com. And look, I encourage you to do one of two things. If you're obviously curious about having a conversation as to what it would look like to work together, and I can give you my opinions about where you are today from a wealth management standpoint, please contact me. There's a contact page on our website, but honestly, just drop me a line. One of the beautiful things about running a boutique wealth management firm is I want it to be personal. So my email address is jonathan@treussard.com, JONATHAN @treussard.com. But if you're not, there, if you don't want to have that conversation, at a minimum, please sign up for our newsletter. I put out a piece roughly twice a month. I try to be a light spammer. I try to keep it, light and interesting. And at the bottom of every one of our pages on the website, you can just put in your name and email address, and you'll be added to the mailing list, and you'll be getting the newsletter twice a month, roughly.
Great. All right. And look, Jonathan, when I edit this, I will put up the links to your website and your email right there on the screen. You're a brave man to share your email. All right. I'm going to do a couple quick, like 30 seconds of housekeeping, and then I'm going to ask you the last question,
Yeah.
Jonathan, just so you can noodle on it, which is, we've been talking all about financial related topics so far. What's one non-money related investment you would encourage folks to consider adopting in their lives? So folks, right before we get to that, if you've enjoyed having Jonathan on, would like to have him back on this program again, particularly when his bubble meter ticks up or down next, there's some material change in it, let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Just a reminder for folks too that everybody who is a premium subscriber to our Substack gets my Adams Notes summaries of all the interviews that we do on this channel, including this one with Jonathan. One quick note, well, we've just added an executive summary feature to it. So in addition to the full write-up, it now begins with a couple of bullet points, just capturing like the key, most important takeaways from the conversation, in case sort of the TLDR version, too long didn't read version of the notes. And then, so to get the Substack, obviously just go to adamtaggart.substack.com. And then lastly, to echo what Jonathan said there, and echo what I say on every one of these programs, is for the vast majority of people watching this, trying to navigate these markets that we're in, particularly given how stretched they are, 4 out of 5 on Jonathan's bubble meter here, can feel very overwhelming for the majority of people. I literally just sat down with a couple that's retiring, actually have a fair amount of capital, but very little experience never managing it themselves. Guy was an entrepreneur focused on his business. They're feeling very vulnerable now about making sure that what they've worked so hard to amass lasts the rest of their lives. You know, I gave them the same advice I give everybody here every week, which is the vast majority of people should be working under the guidance of a good professional financial advisor. Not just one who's good in general, but one that takes into account all of the macro issues that Jonathan and I have been talking about here. And when you add that requirement onto the universe, it actually starts getting much smaller than you would expect. You know, there's a lot of advisors out there that cut their teeth on, you know, the 2010 through 2021 era, where you could really do no wrong because of all the intervention by the Federal Reserve and the central planners that just kept stocks moving up year after year after year. Now, we are in a different era now, and we're now in one where valuations are super stretched again. So anyways, make sure you're working with one that understands that backstory so that they can take all that into their portfolio allocation for you. So if you've got a good one who's doing that for you and implementing it for you, taking care for you as a good financial quarterback, great. You should stick with them. They're very valuable. But if you don't have one, or you'd like to get a second opinion from one who does, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses, that the guys you see with me on this channel week in and week out. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple of seconds. These consultations are totally free. There's no commitment to work with these guys, just a free public service they offer to help as many people as possible, position as prudently as possible for what may lie ahead. All right, Jonathan, we're back to you. What is one non-monetary related investment that you think is worthwhile folks consider?
A couple of years ago, someone mentioned to me Martin Short's multi-dimensional, whatever, life assessment method. You know, comedian, and I think you can Google
the Saturday Night Live comedian Martin Short?
Yeah.
Okay.
And basically the story, and I've been doing it for myself, and I've found it very helpful. He woke up one day famous, and he realized that if he predicated, you know, how he's doing in life on the basis of whether he's more or less famous than yesterday from the point that he was now at, it was going to make for a pretty miserable existence. And so you know, kind of came up with, I don't know if it's 8 or 9 categories for himself. And they truly spoke to me. It's not just how famous or rich you are. It's about how you're doing with your friends, how you're doing with the family from which you came, you know, your parents and so on, the family you now have. Do you feel creative or do you not feel creative in your own professional efforts, so on and so forth. And so I really encourage people to look up, you know, again, I think if you Google Martin Short's, whatever, you know, dimensions of happiness or something, it'll come up. And it's not a bad idea once in a while to try to see how you're doing on these dimensions. And look, if you find that you derive a lot of joy from your friendships and you haven't been nurturing them as much as you might have last year, maybe lean into that a little bit, you know, that sort of thing.
All right, very, very well put. And as I think people are noticing on this journey of me asking a lot of the wealth experts on this channel this same question, it seems very clear that the people who spend the most time in the realm of money understand the best that money isn't the source of happiness in life, right? It can be a catalyst, no doubt. But the things that really bring us fulfillment and joy, and when we look back at, you know, our lives and say, was it a good life? Money is not playing the starring role. It's all these other things. And so it's great to hear that you are adding additional validation to that. Well, Jonathan, look, this has been a wonderful discussion. I'm so glad that you come on the program. We've now gotten to know each other. The audience has gotten exposure to you. Really look forward to having you back on in the future if you can make it. But the door is open here anytime.
Thank you. That was lovely. I look forward to it.
Great. And everybody else, thanks so much for watching.